Hello everyone, this is Orhan. In this video, I'm going to talk about one of the fundamental theorems of finance, which is called efficient market hypothesis. I will start this lecture by telling you a story. On Tuesday, January 28, 1986, the Space Shuttle Challenger took off from Kennedy Space Center at Cape Canaveral. So 73 seconds into its flight, Challenger exploded. Unfortunately, at first, nobody knew what had happened, and then media started to speculate on the causes of the disaster based on few seconds of video. One of the rumors was fuel tank. People were speculating about a leakage in oxygen line, or saying that there was a flame burning through one of the solid booster rockets. Rumors abounded for weeks before NASA released more data. 6 days after the disaster, President Reagan signed an executive order establishing Rogers Commission, an impressive 14 or 15 members panel of experts that included Neil Armstrong, the first person to walk on the moon, Nobel Prize winning physicist Richard Feynman, among others. On June 6, 1986, a little over 5 months after the disaster, after conducting scores of interviews, analyzing all the telemetry data from the shuttle's flight, holding several public hearings, the Rogers Commission concluded that the explosion was caused by the failure of the shuttle's now infamous O-rings on the right solid fuel booster rockets. So you see Richard Feynman here making a demonstration in front of the media. 4 major NASA contractors were involved in the Space Shuttle program: Lockheed, Martin Marietta, Morton Tycol, and Rockwell International. The release of the Rogers Commission report was bad news for only one of those companies, Morton Tycol. So the contractor that built and operated the booster rockets. The question now is, how long did it take for the market to process the Challenger explosion and incorporate it into the stock prices of the 4 NASA vendors? Was the day after the release of the report, a week, or a month? Well, in 2003, almost after 20 or 30 years, the disaster, so 2 economists, Michael Maloney and Harold Mulhern, so they wrote a paper analyzing the situation. This is their paper. So they say that they just answered this question, and the result was shocking. The stock market punished Morton Tycol not on the day of the report, nor after Feynman's brilliant live demonstration of the defective O-rings, but on January 28, 1986 itself, within minutes of the Challenger explosion. The price drop in Morton Tycol stock began almost immediately after the accident. After the explosion. So the price drop in Morton Tycol stock began almost immediately after the accident by 11:52 a.m., only 30 minutes after the explosion. So this is Morton Tycol, the square, the line with the little square markers is the Morton Tycol stock price. New York Stock Exchange had to halt trading in Morton Tycol because the order flow overwhelmed the exchange systems. By the end of the day, it was almost down by 12%. Morton Tycol stocks were almost down by 12%. Well, if you are cynical about the ways of the stock market, you might suspect the worst. So you might say that people in the know at Morton Tycol or NASA realized what had happened and began dumping their stocks immediately after the accident. But Maloney and Mulhern, that paper I showed you a moment ago, were unable to find any evidence for the insider trading on January 28, 1986. What took Rogers Commission, with some of the finest minds on the planet, 5 months to establish, the stock market was able to do within a few hours? How on earth could this have happened? Well, we call it efficient market hypothesis. Okay, efficient market hypothesis is basically saying that people are rational, and efficient market is one where asset prices adjust almost immediately to the arrival of new information. So it's basically saying that these two things cannot happen in a market. Okay, first assumption is people are rational. So if people are rational, two things do not happen. The first one is people beating the market, or the second one. The first one is asset bubbles. Okay, so let me just like review the implications. The first implication of efficient market hypothesis is saying that prices fully reflect all available information. I will explain in a moment what all available information means in a second. So the first one, once again, prices fully reflect all available information, which means that prices are correct, even though there can be random deviations, but the prices are correct is the first assertion or first implication, first biggest implication of efficient market hypothesis. Second one is no group of investors should be able to consistently beat the market. That's the second one. So please, so these are the two most important implications of efficient market hypothesis. So please keep in mind for the rest of the lecture, these two implications. So why does efficient market hypothesis matters, or market efficiency matters? Just because if markets were not efficient, the market price may deviate from the true value, and the process of valuation should be directed towards obtaining a reasonable estimate of that value. So what efficient market hypothesis does not imply, this is important, so let's talk about the other way around. So it does not say that stock prices cannot deviate from the true value. It can, but that deviation should be very little, and it should be random. So random deviations is fine. Okay. The second one, it does not say that no investors will beat the market in any time period. To the contrary, like approximately half of the investors can beat the market or should beat the market in any time period, because it's random meaning how should be beaten. Okay. The third one, it does not say that no group of investors will beat the market in the long run. These are the three things that market efficiency does not imply. Okay, it does not say, once again, the third one, it does not say that no group of investors will beat the market in the long term. Yes, they can beat, but it's not because of their investment strategy, but because they are lucky. Okay, randomly you can beat the market, but consistently you cannot. That's what the market said, what the theory says. Remember a moment ago I told you that I will explain what all available information mean. So there are three types of efficient market hypothesis. The first one is called weak form. The second one is called semi-strong form. The third one is called strong form, and I will explain what they mean. They all vary what they say about the available information. Okay, the first one, weak form of the theory, says that you cannot predict the market using the past prices and volume of the stock. Okay, which means that their past prices and volume are of no use in beating the market. If this is true, then technical analysis is of little use. Okay, the second one is saying that you cannot use publicly available information to beat the market or to predict the market. If this is true, again, the fundamental analysis is of little use. The third one is the strongest one, as you can understand from the name. It's called strong form of efficient market. It says any kind of information, public or private, like they are of no use in beating the market. So you cannot use any kind of information, including the insider information, to beat the market. So there's no way that you can beat the market using this information. So these three types of efficient market hypothesis vary about what they say about the information. Okay, the first one is related with past prices. The second one is publicly available information. The third one is any kind of information. So as you can understand from these definitions, the strongest one is the biggest information set. Semi-strong is smaller, weak form is the smallest. So these are the hypotheses, different hypotheses the theory asserts. They should all be tested, of course, so they are not like 100% true or wrong, so we should test these theories. In the coming videos, I will show you at least visually how to test those things. But for the moment, let's remember what these two implications of the theory. Remember, the first one was saying that prices are true, prices are correct. Second one was saying that you cannot beat the market consistently. Well, second one still holds, like the evidence against it is not very strong. Look at this graph, for example. It just shows you the percentage of managed equity funds beating the Vanguard 500 index one for the 29 years. So as you can see, out of this 29 years, in 9 years, more than 50% of the managed funds beat the market, which means that still not more than 50% of the people can beat the market. So the second assertion is still very strong. People still cannot beat the market as the theory predicts. So even though there are little evidence against it, there are very little. But the first one, prices are correct. There are tons of evidence against it. So I'm going to review that part in a moment. So there are like two tests to check if the theory is correct or not. The first one is checking autocorrelations between the returns. It's testing the weak form. The second one is checking the abnormal returns. So it's testing the semi-strong form. In the next video, I'm going to show you at least visually how to check these data. Now let's go back to our first implication once again. So are the prices correct as the theory predicts? Paul Krugman, one of the Nobel-winning economists, he said the belief in efficient markets blinded many, if not most, economists to the emergence of the biggest financial bubble in history. So we believe that the prices are correct. It implies, again, if the prices are correct, there cannot be bubbles in the market because bubbles are overpriced assets. Okay, so the prices of assets, if the price of assets are correct, so they cannot be overpriced for a long period of time. There are a couple of evidence against it. Let me review it one by one. So here in this chart, you see average first day returns of the IPOs. In this column, you see average first day returns of IPOs, initial public offerings, between certain years. As you can see, the average first day returns are all positive, which means that if you had invested in those years in IPOs, you would have made like positive returns for every single time period shown here. So it is kind of saying that it's an evidence saying that prices might not be correct. So if you consistently make money, the prices are not correct. I'm going to show you 4 different investment strategies, and then I'm going to ask you to pick one of those strategies. So here in this chart, you see 4 different strategies: the purple one, the white one, the blue one, and the orange one. So you see their performances from 1995 to 2005. Looking at this performance, which investment strategy would you pick? Assume that these are 4 different assets or securities: purple one, white one, blue one, orange one. So orange one is consistently increasing. The blue one just deviates a little. White one, just like there are ups and downs, like strong deviations. Purple one deviates a lot. By looking at the history, just pick one of those and I will show you their performance after 2005. Okay. So is it possible to predict the market looking at the past history? Remember, weak form of efficient market hypothesis was saying that. Look at the chart now. As you see, the white one, it plummeted. The blue one, it just skyrocketed. And then purple line is fine. And the orange one, again, consistently increased, even though this chart is after the coronavirus market collapse. Okay, so the blue one is kind of like overperforming. At least it's better than others. It's not easy to predict the market looking at the past history. So the white one, again, does not seem to be plummeting, at least looking at its performance before 2005, but it did. This was one thing. The other thing is, so there are tons of like evidences, like papers, studies done showing that prices might not be always correct. One of those came from Bob Shiller, Yale University professor. He calculated the present value of stocks in this chart and just like compared it with the real value of those stocks. Basically, finance theory says that the price of any financial asset is equal to present value of all future cash flows, like dividends. So if you take the present value of all future dividends, it should more or less be very similar or should be the same as the stock price. So there should not be too much deviations. Random deviations is fine, but too much deviations is not fine. The black one is the present value of future cash flows. The red one is the stock prices, real stock prices. Okay, so random deviation is fine, but look at 1920s, look at 1960s. It started from 1960s here, okay, and it ended up, it's not random deviation, it's too much deviation. So it showed that Bob Shiller said that there's an excess volatility in the stock market with respect to present value calculation implied by the efficient market hypothesis. This was the first evidence against the theory. This paper was written in 1981, I think. The second evidence about the trading volume of the stock exchanges, please take a look at this graph. I prepared this graph in 2015, so I'm going to show you what happened after that too. But this graph shows you the trading volume in organized stock exchanges. As you can see, these stock exchanges trading volume is huge. Okay, if efficient market hypothesis was true, which means that the prices are true, prices are just randomly deviates from the true value of the stock, then you should not trade too much because you cannot beat the market like consistently. People should not trade too much, okay? But look at here, the trading volume of some stock exchanges are really huge, especially Shenzhen, Shanghai, Taipei, Borsa Istanbul, and Karex Korea stock exchanges. So Taylor in 1995 wrote another paper after Shiller. He said, or they said, that high trading volume on organized exchanges is perhaps the single most embarrassing fact to the standard finance paradigm. So you see their performances after 2015 here, 2015, 2016, and 2017. Again, these 4 stock exchanges, they still kind of like have huge turnover or trading volume. So it's another evidence against the theory. The other one is bubbles. So if the prices are correct, we should not observe any bubbles in financial markets, okay? Is it true? I will show you 2 or 3 examples about the stock market or any asset bubbles. So again, let me repeat, efficient market hypothesis says that prices are correct, so there should not be any bubbles in the market, just because if the prices are correct, its true value should not change overnight, okay? But that's not what we observe. I'm going to show you now, this is the Case-Shiller House Price Index in United States. Please take a look at this graph from Bloomberg. This is the Case-Shiller House Price Index. As you might remember from those days, like almost 12 years ago, the house prices peaked around 2007, 2006. And all of a sudden, in just a couple of months, the house prices plummeted, okay? And then it took almost 12 years for house prices to come back, okay? So this is 2012. So if the prices are correct, we should not observe bubbles, but there are bubbles in markets, okay? This is one example. The other example is CUBA. So CUBA is a mutual fund, which still is being traded. So it has nothing to do with Cuba, by the way. It's a mutual fund whose name is CUBA. So they were traded in stock market those days. And then look at their stock prices at the end of 2014. It was around like $6.81. All of a sudden, it skyrocketed in just a couple of days to $14. So it almost doubled, okay? And then it took almost maybe a year for the stock price to come to that level. So the question is, what happened here? Okay, what happened so that the stock prices doubled? It is because President Obama, then President of the United States, he just announced that he's going to relax the embargo against Cuba. All of a sudden, people rush to buy this stock, but it has nothing to do with the Cuba. Just it's a similarity. So the name is people confused with the name. So they realized the next day that it was a mistake. Stock prices came back almost to $9. But again, I mean, we started from $6, so it increased to $14 and it came back to $9. It took almost a year for the price to come back. So it took a year for people to realize that that was a mistake. So this is a kind of, again, this is another type of bubble, okay? We know that that's not correct, but people still could not correctly value the price of that stock. Just because of a mistake, it doubled, but I mean, the next day it did not come back exactly to the same level. So this is another interesting example. The last one I should show you is Long IST Corporation. So this is another example that I should show you. Again, we are talking about bubbles. So are bubbles possible to form in efficient markets? The theory says no, but there are really interesting examples, the interesting evidence against that. So this is long blockchain equity. It was, again, through the end of 2017, the stock price was around $1.70, and it skyrocketed to almost $7 in a few days, just because Long IST Corporation, which were selling IST those years, they changed their name from Long IST to Long Blockchain Corporation, which was a popular term, which still is. And then people rushed to buy that stock, believing that they're going to invest heavily in blockchain technology. And then people believed in that. So stock price increased from $1.80 to $6, almost $7. And it again took almost 3-4 months for people to realize bubble there. And then now the stock is being traded at 11 cents. Okay. So the question is, what is this then if it is not bubble? Is it just like a temporary hype of the people? Or is it something else, or is it a bubble? So these are the problems associated with the efficient market hypothesis. Once again, let's remember what the theory says and then finish our lecture. The theory says that people are rational, and if people are rational, two things cannot happen. The first one is they cannot beat the market consistently, and the second one is there can't be any asset bubbles. So I just presented the theory. I presented you the evidence against the theory. In the next video, I will show you at least a visual test the hypothesis. And then after that, I'm going to start behavioral finance theory, which is associated with the anomalies related with efficient market hypothesis. I hope you enjoyed the video and benefited from it. See you in the next class.